The intent to exit the highly inflated, faith-based fiat dollar is clear. The U.S. national policy has weaponized the dollar as leverage in international trade. The unfair use of this leverage against trading partners, exporting U.S. inflation by forcing countries to hold depreciating dollars in reserve, the ever-growing national debt, and excessive money printing is just scratching the surface. The BRICS currency will merely serve as a finishing move. Fortunately, this change will be gradual, which buys time for the ordinary investor. To bring context to the BRICS currency and gradual de-dollarization, we will hear from Jim Rickards.
The United States has been the dominant reserve currency since Bretton Woods in 1944. Very important to the U.S. economy and U.S. citizens. Maybe a good way to start is to explain what a reserve currency is, because there's a lot of confusion about that. I think of it as your savings account. So you make a certain amount of money, you spend a certain amount of money. Hopefully we spend less than we make, and we have some savings. Well, the savings are our reserves. We have to do something with them. We can't put them under a mattress. We can put them in the bank. That's pretty conservative. We could buy stocks. It's a little riskier and so forth. So we put our savings to use. Those are our reserves. Well, countries are no different. You trade with other countries. If you export more than you import, you're going to have a trade surplus, and that is added to your reserves. Now, the question is, what do you do with your reserves? How exactly do you invest them, and what currencies do you choose? That's where the dollar comes in. Far and away, over 60% of all global reserves are in U.S. dollar-denominated securities. Could be real estate or stocks, but it's overwhelmingly U.S. government obligations and U.S. Treasury debt in particular. That's an enormous advantage for the U.S. because it means our costs of financing are lower, which means our deficits are lower, our economy is stronger. Imagine if we had to finance the U.S. deficits with no foreign buyers. Imagine what that would look like. Our interest rates would be a lot higher, our stock market would be lower, our housing would be lower. When you are a reserve currency, other people are funding your style of living, so to speak. Just look at the Argentinians. They're not a reserve currency. If they want to borrow, no one's going to allow them to issue Argentinian peso bonds. They have to borrow in dollars. So when you're not a reserve currency, you have to borrow in whatever is the reserve currency. So imagine a world where, let's say, the euro or something else was the reserve currency, and we had to borrow in euros. Well, all of a sudden we'd be vulnerable to exchange rate risk. You'd probably have much higher inflation. By the way, this happened once before in the late 1970s. The dollar was under so much attack and so much stress that Jimmy Carter actually borrowed in Swiss francs. The dollar was so unwanted and so in danger of collapse in the late 1970s that the United States had to go to the marketplace, and we issued Swiss franc bonds. They were called Carter bonds. So, and remember, that was a period of high inflation from 1977 to 1981. Inflation in the United States in those 5 years was 50%, 5-0. The value of the dollar was cut in half in just 5 years. So that's what, when you're in danger of losing your reserve currency status, that's what happens. So it's very valuable to the U.S. Unfortunately, we may be in danger of losing that status again. Over 60% of the reserves are in dollars, which they are, but in 2000, that number was over 70%. So the U.S. role as a reserve currency has dropped from 70% of global reserves to 60% of global reserves. Imagine if that kept going, and all of a sudden we're 50. 50 is kind of a tipping point. When you're below 50, you're no longer the dominant reserve currency, and you might see euros and other currencies coming up.
Clearly, what they're doing is diversifying away from the dollar. Take China, for example. I mean, they're bleeding reserves, first of all. Their reserve position has dropped. They fear, and I think rightly, that we're going to try to inflate our way out from under our debt. That's the American way. Like, we don't actually default, we just inflate the currency away. So we say to China, here's your $1 trillion, good luck buying a loaf of bread. And there's not much they can do about it. They say, why don't they dump the treasuries? Well, they can. I mean, the treasury market is large, but it's not that large. It can't absorb that much selling. But what they can do is buy gold, which they're doing by the thousands of tons, by the way. These are enormous purchases that are going on. If the U.S. does inflate the dollar and does destroy the value of the paper, what's going to happen to the gold? It's going to skyrocket. So what you have is a hedge position where it's like a seesaw. They own both sides of the seesaw. One goes up, the other goes down, but they maintain the value.
But investors need to look forward. I call it the curse of the 2-second attention span. People worried about what's happening today or tomorrow. Well, that's fine if you're a day trader, but if you're an investor, you're worried about your retirement, you're worried about wealth, your children's well-being, etc. You ought to be looking a little further down the road. If we lose our reserve currency status, I mean, the Treasury will still issue debt, but the American people are going to have to buy them. The foreign interest will be reduced. Foreigners will say, hey, U.S., you want to sell bonds? Price them in something else. Right. Well, the first piece of advice I would give is position now. One of the questions I'm asked most frequently is, hey Jim, when's it going to be? What's it going to be? You know, almost as if I'm supposed to call them at 3:30 in the afternoon the day before, and they're like, oh, I'll sell all my stocks at the close and buy gold the next day. It doesn't work that way. I can see it coming, and I can describe the dynamics, and I can understand the magnitude of the risk, but I'm not going to know what day it is because it's going to be some unexpected event that maybe none of us see coming. I can just tell you it is coming. So first of all, position yourself now. What I recommend to investors, you want about 10% gold. You know, maybe a little more if you want to lean into it if you have a higher risk appetite, but not much less than that.
As the Federal Reserve props up the strength of the US dollar with high interest rates, this lowers the price of gold. This is the opportunity. With the inevitable Fed pivot and more money printing, gold prices will rise. To paraphrase the famous hockey player Wayne Gretzky, I go where the puck is going to be, not to where it was. He also stated, you miss 100% of the shots you don't take. For additional resources on how to protect your wealth, see the links in the video description. Thank you for watching.